if your property has doubled in value, it's probably your worst performing asset.
That's kind of what we're evaluating right now with the properties we have, because a lot of these properties that we have doubled in value or even tripled in value. And what happens is it gets to a point where you can only pull out up to 80%. So you got to refinance everything. And that's hard to do right now. We've got a lot of like trapped equity that we can't get. Some of these properties, you might still be leaving several hundreds of thousands of dollars locked up in there that you can't go to work for you. The American dream is to buy a house, pay it off in 30 years, and you own the house. So if that's your goal, that's great. We view homes differently. But one thing that we've come to realize is that, wealthy people tend to optimize for return on equity, whereas most investors are always looking to optimize cash flow. It's like, how do I get the best cash flow? And I think we got caught up in that a little bit, like just making sure we're covering the payment and then creating extra cash flow. And that sounds good, but when you look at your equity that you have, and return on investment is one thing, got to start looking at your return on your equity. That's really your opportunity cost. You got to look at what could I do with this equity if I pulled this out of the home and deployed it elsewhere into other investments or bought other properties. And so that's kind of where we're at is, we're looking at optimizing our return on the equity.
Welcome back to The Broke Billionaires, where we document our daily struggles in building wealth while raising a young family. Join us as we talk creative wealth building for everyday people and couples that are struggling in a down economy. I'm Lauren.
And I'm Joshua Masari, and we'll be your host.
Welcome back.
Welcome.
How's it going?
It's going pretty good. We're back in the studio. We guess we didn't take a break. We did an interview last week, virtual interview, but back in the studio for ourselves, and we got a few guests that we're getting lined up for coming weeks, and we'll see how that plays out. And so what are the updates that we have for now?
Let's start with the never-ending roof situation. It's
gosh.
so close. We're so close.
So we've got this property we've talked about several times that has a cedar shake roof. We couldn't get insurance. We had to get super expensive out-of-state insurance on it or not admitted insurance, and it was just costing us an arm and a leg. We have a path forward on this, and I think we finally figured it out. We had to get very creative.
We always do.
We'll break this down fully, probably a full episode just breaking all this down, but we are almost there. Tomorrow, the roofers start the demo with ripping it off. So we are very close to getting this done. And as soon as that's done, we're going to get our regular insurance back and save about $13,000 a year.
Sounds really nice.
So we'll see how that plays out. But we are very, very close. We've been talking about it for a long time, but we are actually there.
We can see the light at the end of the tunnel.
Yeah, 24 hours.
In terms of starting it.
Yeah, within 24 hours, there should be no roof on there. It should be all tore off. Then we just got to get them to put it back on. But that's another story.
Yeah.
So we'll see how that plays out. We are, another update I want to talk about is how we're implementing AI into our businesses. And I feel like this is changing so rapidly. Like, we've been implementing this for the last few months into the print business with an AI agent to basically take emails from people, find their previous order, like process the orders and take care of it for them. And I feel like at the time that we started it, we're in the testing phase this week and rolling this out hopefully in the coming weeks. But I feel like it's already like antiquated software. There's already new stuff that's like come in and it's like, just like everything is evolving that fast.
Does this like scare you at all?
It should scare anybody.
Yeah.
So I saw a chart the other day that showed 16 industries, and it broke down which industries that AI was going to infiltrate and replace jobs in. And out of the 16, it was like 14 or 15 of them were like almost fully replaced with AI. And then it showed this chart and this like graph chart that went, or a pie chart that went out. And there was like one section, which was the food industry that wasn't getting replaced by AI. But I feel like it's probably like farming and stuff, I feel like is going to have more and more AI implemented into it. But it was saying that was not going to replace jobs, or at least not as much. Sales and marketing and, legals, attorneys, and even healthcare, like all these jobs getting replaced with AI. And then it showed in the middle in red how much AI has already taken over. And it was like almost nothing. So it's like, this is what it's going to be in 2 years, and it hasn't even scratched the surface yet. So that's very scary. I watched a call with Dan Martell over the weekend, and it was a very interesting call. It was actually a live call with Cassie Warren from our group. And it was a very interesting, Dan's real big on AI. And so like the everything changes weekly. He's always updating on what AI programs are out now and which ones to use and which ones aren't worth it. But so Dan Martell is starting to get into real estate now because he's a software guy. All of his money's tied up in software, and that's kind of where he's been. But he's looking to move some of his wealth over into real estate. So he's doing something right now where he is buying a 36-unit apartment complex, and he's negotiating, looking at the finances, and he's got a team put together for this. And the team is, reviewing the financials and going back to the seller's agent and saying, you guys have made a mistake on your financials this year, and then basically using that and leveraging that and negotiating down based on incorrect financials and just all this. Anyway, he's got this team that's putting the whole deal together, negotiating it, and going to close it. Once it closes and he signs, he's going to, he hasn't even told him this. There's not actually anybody doing this on his team. It's all just AI that he built. So it's all like literally all these AI agents, an AI agent is not a real estate agent, but an AI agent that just goes and does all this research and takes the data, the financials, processes it, finds mistakes. It's all just AI working together as his team to do this real estate transaction. And so he's completely replaced a traditional realtor and CPA and all these people that would normally look over a deal, and it's all 100% AI. So once he does this, he's going to take this and probably package it up and sell it as a product. But it's funny because the other side probably has no idea that they're just talking to a computer, and the computer's coming back and saying, "No, you're wrong. We're going to, it's insane."
So wild.
The other thing that this should kind of scare you. Dan is, big SaaS guy, big software, big AI. And he has a huge content team. Like he's probably one of the top content creators in terms of, maybe not like Mr. Beast, but like in terms of the industry he's in, he's probably one of the top, has the biggest team, spends the most money on content, and doesn't spend any money on ads. It's all organic. But he has probably one of the biggest, most well-trained teams for this. And he just told his team, we are getting rid of all of you. Not in a like, you're fired, but like, you're going to get replaced, and we're implementing AI now, building out AI now. So like, get on board and make yourself valuable and get in, because you are going to get replaced. So I'm sure that's pretty scary for the people that aren't ready for that shift. He has his main guy, Sam, who he's keeping on, but Sam's now taking their entire content workflow and automating it all with AI. So, which I'm actually looking at doing for ourselves, because even though we have editors now, it's still, the workflow is still a lot of manual work. And so I'm trying to figure out, how do I build an AI agent we record and then just upload it, and then it does everything that I do from start to finish, sending everything to the editors, but with all the notes and everything figured out, and just like does the whole thing. So it is scary. If you are an employee, you should be scared, because it's going to replace a lot. So I think the way you get around that, or the way that you combat that, for the people that are just like resisting AI, because there's still people resisting AI and just like, oh, I'm not going to give in, and that, I'm whatever, like, you are going to get left behind.
It's like when I resisted the iPhone. Didn't want to give up my BlackBerry.
You got left behind.
I got left behind for a while.
and I'm making major shifts. I'm just thinking already, like, how do we make shifts in our businesses to not get left behind, because it is going to be a very quick change. Because now it's no longer, and even like coders and engineers, they say like, oh, the engineers that do all the coding are always going to have jobs. Like, they're getting laid off right now. Facebook just laid off like 10% of their workforce last week and replaced those people with AI to do the same job. So like, these software companies are at the leading edge of this, and they're laying off humans, replacing with AI. So it's happening very quick. AI is now building AI. So if you want to build an AI agent or build a website or something, you don't have to have a developer do that anymore. There's programs that cost $20 a month that will do all this for you very quickly and instantly, like literally like within 10 minutes. I was on a call last week, an MTR call, and people were asking how to build websites. Like, how, where do I go? And people are like, oh, go to Wix, go to this and go to that. while we were on the call, one of the guys at the very end posted a website that they had just finished for FIFA World Cup. Like they did a whole landing page for this. I took his website, I dropped it into my AI agent and said, build me this website, replicate this website with our branding, our logos for our area and everything. And within 10 minutes, I was trying to do it before the call was over, but it was like 5 minutes after the call ended. But it literally created a whole landing page, looked great. Someone that had spent probably hours and hours building this, and within 10 minutes had the same bones of the website, looked the same. It even made pictures. So they had theirs for MetLife Stadium on the East Coast in New Jersey. And I said, build it with, for FIFA World Cup around SoFi Stadium. And it made an image using Nano Banana, created an image as the backdrop of the website, made this gorgeous looking website, rendered all these photos, and within 10 minutes. And the cost on it was probably like $2 that it took out of my account.
I mean, I think there's so many positives with AI, but there's also so many things that are just a little terrifying, if I'm being completely honest.
If you're an employee, that should absolutely terrify you. And as a business owner, it scares me too, because a lot of middlemen are going to get cut out. And this is one thing that Dan was talking about on this recent call. Real estate agents. Like, I think there'll always be a place for them, but it is going to weed out a lot of real estate agents. There was already, just in the news last weekend, there was a guy in Florida that sold his house, just a homeowner, sold his house with an AI agent. It did the whole listing, the marketing, everything, sold it, took it to the title, so it got all the way to the title company for the closing without anybody touching it. Crazy.
Scares me. Did you ever watch Smart House growing up? Remember that movie?
I sounds familiar, but
So this family, I don't know what year it was supposed to be. This family moves into this like first smart home, and the home like does everything for you, right? Everything our kids talk about. It's like they make you smoothies, they clean up, they do all this, but then the house turns on them. What have I always said? That's what like scares me with all
no,
this.
I think it's
completely can turn on you.
Yeah, I think that can happen. I think it's so there's a lot of precautions, but there's only so much. But it's kind of like what do you do? Do you go along with it and get or you get left behind and stay away? Like, what do you can go live in a cabin in the woods and live off the land. That's the other option.
Sometimes that sounds nice.
Yeah, a lot less stress. But it's just one of those things. It's like, what do you do?
Yeah.
But anybody that's in like a middleman distributor, if you're a realtor, we have a distribution company with the print, so we're trying to figure out how do we implement AI to like handle everything, process everything, so it's faster. Gets I'm working on building an AI agent, so when people call or email, they can go to the website or by email, it'll send back suggestions for products. So somebody says, hey, I need this or that. It'll automatically find the best fit for whatever event they're doing. And because that takes a lot of time. That's the part that takes the most time in the business, is doing all that research. So if we can automate that and get them instant answers, they don't have to wait a day or two. We're just getting them instant answers, instant quotes right away. So I know nobody else in my industry is doing this, but people that don't get on board are going to be left behind quickly. So I'm scrambling. I'm really scrambling because I see that this is where everything's going and it's going to be a problem. And I'm scrambling to try to get ahead of the curve because I know that you're going to get left behind real fast, because the curve of AI is just going like this. Like AI building AI now, and it's just like it's rapidly, like it's just crazy how fast everything is coming out now, and all these new programs that didn't exist yesterday, and AI literally wrote it overnight, and now you got a new program that does something else. So, yeah, it's scary, but I think getting in the forefront and creating AI to generate an income for you is going to be huge, because if you don't do that, you're not going to have an income. And they talk about going and having taxes on companies that use robotics and stuff, where they're going to have to get taxed for not hiring people, and that's going to go into a pool, and it's going to be a universal income that everybody just gets a set amount, which it's not going to be much. It's not going to be. You're not going to be able to build wealth. So I've actually heard this, that we only have a few years left to really like build wealth, kind of what we're doing now. It's going to be a lot harder in a few years because you're not going to have jobs. So it's going to be a lot harder to create the income. So figuring out a way to have AI generate income for you now, like get ahead of that curve and start generating income using AI before you get too far behind. So yeah.
Nothing like a nice anxiety spike first thing in the morning, huh?
So if you have any ideas, like definitely throw them out there, because we need to be just getting our mindset thinking that way. Because if we wait for 2 years, it's going to be too late, and everything's going to be already like ahead of us, and we'll be left behind. So I think you got to get ahead and got to be on that forefront and be thinking that way. How can AI create income for you? Everybody's starting to use ChatGPT and AI to make themselves more efficient. I think people are realizing this really helps. This really has a value, but making that shift to figure out how to use AI to actually generate real income is where it's going to be at. And Dan talks about this too. Like that's where that shift, that mental shift needs to happen is you need to create the AI to generate real revenue for you. So
Oof.
the world's not ending, but it's changing real fast.
Yeah, that's for sure.
Yeah.
What else we got?
That was heavy. We'll probably do a full episode on it once we have some of these other programs up and
I'm
running.
have to really mentally prepare for that.
Yeah, we'll do an episode on that for sure because we are implementing it so heavy into our businesses. So, there's still going to be manual stuff that has to be done, but then again, you got robots coming right behind all this stuff. So, Tesla just stopped making the Model S and Model X to their flagship vehicles that made Tesla who it is. They just stopped. They're no longer making it. And the reason is because they are using that factory to start building robots. So they're like, these $100,000 vehicles that made Tesla what it is not where the future is. And we will make a lot more money shutting all this stuff down and just starting to build robots.
No.
So our kids, it's funny because our 2-year or 4-year-old now, yeah, he's 4, keeps asking or keeps saying, I wish we had a robot to do the dishes. I wish we had a robot to clean up. I wish we had a robot. And I don't know where he gets it. Watching something.
It's got to be something he's watching because we don't talk about we don't talk about that when he's awake because I know he would probably get really excited.
They're not watching the Jetsons, I don't think, because the Jetsons, that was the thing, back in the 60s or whenever that came out.
Yeah.
But that is the reality where we are now. You got AI doing all this stuff behind the scenes, replacing jobs, and then the manual stuff is now going to be getting replaced. And these robots are not that expensive. For $20,000, you can get a robot that works for you. I don't know how long it takes to charge them, but if you get 12 hours a day of it just constantly working, that's a pretty huge efficiency advantage for businesses. So I think we're going to start to see a lot of that, which is crazy. It's like watching Star Wars or something, like all the humanoids walking around, like that is going to be our reality in the next couple of years.
Oof.
Heavy stuff.
Heavy stuff.
All right.
Let's switch gears.
Ooh, okay. Just a quick disclaimer. The information shared on this podcast is for informational purposes only and should not be considered as financial, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Your individual circumstances may differ and require specific strategies not discussed here. Now, let's get back to the show. So switching gears a little bit, though, what we wanted to talk about today is we've been reevaluating our portfolio that we have, our local portfolio. We've talked about these houses where we, fix them up, we move into them, and then we pull out equity and then roll it into the next house or fix it up. We have gotten to the point where we have so much equity in these properties. And I think that, like you were saying earlier with the equity, what were you saying earlier?
That if your property has doubled in value, it's probably your worst performing asset.
Yeah, no, I totally agree with that. And that's kind of what we're evaluating right now with the properties we have, because a lot of these properties that we have doubled in value or even tripled in value. And what happens is it gets to a point where you can only pull out up to 80%. And then if you got second and third positions, you usually aren't going to do that. So you got to refinance everything. And that's hard to do right now. And so we're in positions where we've got a lot of like trapped equity that we can't get. So even if you're able to get the full 80%, some of these properties, you might still be leaving several hundreds of thousands of dollars locked up in there that you can't go to work for you. Now, I understand like the American dream is to buy a house, pay it off in 30 years and you own the house. So if that's your goal, that's great. And that's one way and that's a good, safe way of doing it. But what we do is this is not our home. This is not our forever home. We view homes differently. They're an asset for us. They're building wealth and then they're generating income. So what we're doing is evaluating the equity that we have in these properties. And, and what we've done is we've optimized for cash flow on these, which is great. We've done the midterm rental strategy, which has gotten us higher rents, and we've done really well with it. And so we're getting good returns as far as the cash flow. But one thing that we've come to realize is that, wealthy people tend to optimize for return on equity, whereas most investors are always looking to optimize cash flow. It's like, how do I get the best cash flow? And I think we got caught up in that a little bit, like just making sure we're covering the payment and then creating extra cash flow. And that sounds good. And this is an expensive market. So it's a decent, like these are high dollar amounts. So it sounds really good. But when you look at your equity that you have, and return on investment is one thing. Like if you're putting, $10,000 into a property that you buy for, well, just say you're putting $20,000 into a property you buy for $100,000. What's your return on your investment? Which your investment is only $20,000. It's not the $100,000. The other $80,000 is the bank, but your money is the $20,000. But what happens is that if that value doubles to $200,000, you got to start looking at your return on your equity, because you might only have $20,000 in there, so you're getting a good return on your investment. But you now have $120,000 tied up in that property, which is your equity. What is your return on your equity? When you do that, and the return doesn't change, the actual cash flow is the same, but when you're taking that and using that and dividing that by the equity, the 120 rather than the $20,000, the numbers don't look as good. So that's really your opportunity cost. You got to look at, what could I do with this equity if I pulled this out of the home and deployed it elsewhere into other investments or bought other properties. And so that's kind of where we're at is, we're looking at optimizing our return on the equity. And then in conjunction with that, like, what's our tax strategy? So when we run the numbers, it doesn't look so good when we're looking at all the equity that's tied up in these properties. It's like, some of these we're getting like 2 or 3%, even though it's a decent amount of cash flow. It sounds good. It's still like 2 or 3%, which is not great. If you look at the original first property we bought, it was like $17,000 down many years ago. And so the return on that is great. But now there's so much equity tied up in this that we can't even get, because we've kind of outrun that. This property has tripled from what we bought it for 15 years ago on this one I'm talking about. Mm-hmm. So that's kind of where you got to reevaluate and be like, okay, if we were to sell this to be able to unlock the rest of that equity, and then you can take that equity and go buy multiple properties. Now you got multiple properties instead of just one. And then you start looking at your return on your investment at that point.
So then explain to people who don't maybe understand, like, how are we working with taxes with that? Because that's obviously such a key point that we are very aware of.
Yeah. So I think that one of our big things is that with wealth building is creative tax planning. And not everybody, this is the afterthought, I think, for a lot of people, for a lot of investors. We hear people flipping and they just flip and pay the taxes. Like, they don't think about how much, they look at the revenue as their initial profit and then think like, oh, that was a good return. But then they pay half of it in taxes, and like, no, your return just got cut in half because you had to pay half the taxes. Mm-hmm. So how do you optimize that and not pay those taxes? Well, one of the things that happened just the last year is with the big, beautiful bill, they brought bonus depreciation back. So this opens up a whole new plan and tax strategy to be able to defer these taxes. So the way we can look at this is, so one of the things we're looking at is with the tax, issue we have, we're going to have huge tax liability when we go to sell these properties. So because of the bonus depreciation that now came back, we're looking at being able to roll this over into new properties. So what we're going to have to do is we're going to have to buy more properties and do a cost segregation study, and then we'll be able to take bonus depreciation against this. This actually came out last year and was actually retroactively put in place back to January of last year, but it didn't pass till the end of last year. So you kind of already had to have this plan in place. So this wasn't something we would have had time to be able to even take advantage of last year. But with this year, we've got time to plan it. We're here in March, so we've got time to like plan our strategy out, what we're going to do, how we're going to move the money, and be able to, and we might even be able to do a combination of 1031, because with a 1031 exchange, you can roll it over into another investment property and you can defer those taxes. With the bonus depreciation, you can actually bury it and you still have to keep the property for that amount of time, which is usually like 5, 7, 10 years for whatever the depreciation portion is on the cost segregation study. But I think using a combination of that, we'll be able to pull this money out, use maybe a third of it to use as down payments towards other properties. And then we kind of start the clock over on those ones. And then we're getting a better return on our investment or better return on the equity because now we've got the equity going out to 3 properties or however many it is. And then we've also got cash that we now have cash, like tax-free. So we're able to pull that out tax-free and we can deploy that in either more properties or other investments and just create additional income streams for ourselves. So this was not something we could have done before, but now this is a new our strategy has shifted because of this new tax bill. And so we're pivoting our strategy. We're still going to do the same thing, but we're just going to start the clock over so we don't have so much equity tied up in a few properties. It'll just be spread out over more. And then what that does is it's kind of like the velocity of equity, which means the more when you move your equity around, you take it, you split it, you put it into 3 properties instead of 1 property. Now you got 3 properties, and you're leveraged. You're at a better leverage point, so you're not putting as much into each deal. But when the inflation happens or the market goes up, you're getting whatever the appreciation is on that times 3. So you're actually able to increase the velocity of your equity gains, which is it's a lot to take in. But if you like really write it out and break down the numbers, you can see like how powerful this can be. And I think we just kind of got stuck with like, oh, we have all this equity and trying to maximize our income, but not realizing that we could actually be further ahead by doing it this way.
I was going to say, because that's obviously our plan we've always said, never to sell. And what was it the bill passing that made you kind of really sit down and look at these numbers?
Well, we've never said never sell. Like our out-of-state properties, we hold for about 5 to 7 years, and we do this. We already do this with those properties. We hold them 5 to 7 years, and then we sell them, take the equity, and then we'll deploy that into other properties. And so that's kind of like the cycle. With our California properties, it's a little different because they're very difficult to get. It's harder to get. So I think that's kind of our mindset. And we have very lower interest rates. So the ones we're actually looking at selling 2 properties that don't have as good of interest rates and have a lot of equity in them. The one that has has like a 2.87%. Like it would be really hard to sell that and let that go. Yeah. And that one we've been able to tap into the equity on that one pretty well. I think at some point though, it may get to where that one, if it keeps going up in value, at some point we got to look at like, hey, like we could get 3 or 4 properties if we just sell this one and probably be better off. So it may still, and I don't think this works everywhere. I think in California, because of the appreciation we see here, it's an appreciating market. So I think we get more equity locked up in their higher dollar amount properties. The properties that are out of state that are a couple $100,000 properties, and you might have, $40,000 of untapped equity. It's not going to go as far, not going to be able to buy as big of an asset. But when you hear where properties are 10 times more, it all of a sudden becomes a big number. And so I think just making that shift mentally and being able to let go of these properties we're holding, because in reality, we're not really giving up properties because we have to buy more to offset the taxes. So we'll probably end up with more properties at the end of the day. They just won't have as much equity in each one, but they'll still be performing, generating income, paying themselves down, and they'll still build equity. It's just kind of restarting the clock. So it's not all in one basket.
Yeah.
So it actually makes us more diversified. We'll be more diversified. And, if something happens, God forbid, a house burns down or something, obviously we have insurance, but that's still going to set you back. But now instead of only having 3 properties here, we could end up with 9 or 10 at some point or whatever. So it spreads out your risk, I think, too.
Yeah.
You can get into different neighborhoods and have different exposure. So I think it's definitely worth looking into if someone has that sort of situation. But yeah, I mean, because holding a property that has a really low return on equity is, you're really underperforming when you look at the numbers, and keeping that, you're accepting that is an underperforming property when you look at the opportunity cost of what that equity could be doing for you.
Makes sense.
So I think that's kind of where we're at. It's something we've been talking through, and I think we're both see this opportunity. And again, this wasn't as viable of an option before the bonus depreciation came back, and I want to be clear, not anybody can get bonus depreciation. You have to be a real estate professional. It does not mean that you have to be a realtor.
Licensed,
Yeah, you don't have to be a licensed realtor, but you have to be involved in your real estate portfolio. You have to do this more than if you have active income like a W-2 job. You have to be doing this more than your W-2 job. There are certain hours criteria that you have to meet. Like you have to be materially involved. Like you actually have to be active in this business. And there are some people, like if you're married, you can have one spouse that does this and one that doesn't. So if one spouse is a actual realtor, and you're a real estate agent and that's your full-time job, you automatically get the real estate professional status. And then, the other spouse can be, working a W-2 job, something totally unrelated, but you can still do this strategy because that one person has the real estate professional status and you file, as long as you're filing jointly.
Mm-hmm.
So that's a good strategy that a lot of couples have used, is by just having one spouse that qualifies for that, because it'll offset both incomes. So yeah, getting heavy on tax stuff, which I know you love.
Love it. No, I think I'm excited about this opportunity, but it has been a bit of a pivot from obviously what we thought we were doing. And so I think
Well, we didn't expect the values to double in the last 5 years.
No.
So, it's been great and we've been able to tap into that. We bought more properties, but like that, our plan, we did bank on, we were like looking and doing this for appreciation, but we never thought it was going to double. And a lot of that has been because of inflation. So if we can lock this, and the other thing too is if we do this and pull this money out, we're kind of locking in our win. And if the market did cool off and values did drop in our area, now we're not losing equity because we've already taken that out, locked in that win, and we'll redeploy that. But since we won't have a lot of equity in each of these newer properties, if it does go backwards and it's underwater, now it's the bank's money that's underwater, not ours. So the property is still going to cash flow and still pay it for itself. And, it'll go through the cycle. And then 10 years later, we'll have equity in it and we'll probably be in the same situation, or hopefully. But I think it's just a safer move to be able to pull that equity out and have that working for us elsewhere and kind of diversify and we'll be able to create more income than we are right now because our return on our equity is so low. We're not really creating much cash flow that is actual income for us and our family. This will allow us to take that equity, move it into more, income heavy investments and actually start generating income passively, which I'm actually really excited about because that's something that we've been focused so heavily on, building equity, which to get where we needed to get to this position, we had to do that the last 5 years. And we've done a really good job of building up that equity. But now it's time to we've been doing we talked about this. We've been sowing and doing all this. Now it's time to reap what we've sowed and pull that equity out and start taking the benefits and creating income from that. So that part's exciting.
Yeah, absolutely. Okay, I want to go back for a minute when you were talking about bonus depreciation. For those that don't know what that is, break it down a little bit more.
Yeah, that's good. So I know there's a lot of misinformation about this and people just think, oh, you can just take bonus depreciation. It's not that simple. Like I mentioned before, you do have to qualify as a real estate professional. So this is, these are all strategies that we're doing and other people have done, but you shouldn't just do this without talking to somebody. You need to talk to your CPA. All the information, everything we talk about on the podcast, you should always run by your financial advisor, CPA. If you're doing mortgages and stuff, whoever's doing your mortgages, your attorney. These are all things that we talk about is really just meant for education. But these are strategies that are real and that you can utilize them. So tax planning is big. This is not something you can do at the end of the year. You sell in December and then think you're going to take bonus depreciation because you have to buy the next house in December. And if you just buy it before the end of the year, yes, great. But if you don't have real estate professional status built up for the year, you can't do that. So this is something that requires a lot of planning ahead of time. We're talking to our CPA to make sure that we're doing everything correctly to be able to take all this depreciation. But an overview of how bonus depreciation works. So normally with real estate, you'll depreciate the asset over 27 and a half years. And it's the buildings, it's the improvements on the property. Land doesn't depreciate. So let's say you've got a property that's $1 million. And let's say the property itself is worth $300,000. And the county kind of figures out what the land is worth. So let's say the land, it's on your tax bill, it breaks it out. Let's say the land's worth $300,000. And the property that's been built on, or the home and buildings and improvements, are $700,000 that make up that. So normally your CPA would be like, okay, $700,000 is your depreciable tax basis for this property. You take depreciation on this over 27 and a half years. So you can hold that for 27 and a half years. You get depreciation every single year against your income on that property. And that's why real estate is such a, such a tax advantageous asset, because even though you're generating income, you're offsetting that with depreciation. Even though the value keeps going up, you're still depreciating it per the tax code. So at 27 and a half years, you kind of have to sell at that point or do something, because you lose that depreciation. So it doesn't even make sense to hold properties that long, because you start to lose that tax benefit. But with bonus depreciation, what this requires, or what this entails, is you do what's called a cost segregation study. And what that means is there's companies that specialize in this. They'll come in and they'll say, okay, so this building is worth $700,000. We're gonna take a look at all the materials, all the plumbing, the electrical, the HVAC system, all these things that you would buy as depreciating items. And they will do this whole study and be like, okay, this is the value of all these items. So it comes out to, let's say, $300,000, and say, okay, $300,000 and all your materials and everything that you can use and qualify for this cost segregation study. Instead of taking 27 and a half years, now you can take all these individual material items and say, okay, if you replace an item, you actually depreciate on a different schedule than your 27 and a half years. If you replace an HVAC, usually it's going to be like 5 years or 7 years or whatever it is for that specific item. So they'll just do that all up front and be like, okay, these are all the items that you have in materials. You can depreciate this over, let's say, 7 years. Let's say it's a 7-year cycle, just to make it easy, because it actually broke down. Different items have different, like 5-year, 7-year, 10-year, but let's just say it's 7 years. So they say, okay, you have $300,000 worth of items that you can depreciate over 7 years. With bonus depreciation, you can actually front load that and push that all to year one. So that's why it's called bonus. You can take that in year one. So what that means is you can take that $300,000 depreciation and just put it all in year one. And then instead of having that over the next 7 years, you get nothing on that over the next 7 years. So you do have to hold the property for that 7 years to fully realize that depreciation. If you sell it before that, then the IRS is going to do what's called recapture, and you're going to have to pay some of that back. But the other portion of that is, remember, the property was originally, the buildings were worth $700,000, and we were only taking $300,000 on bonus depreciation. So there's a $400,000 difference. That $400,000, you still take that over the 27 and a half years. So you're still getting depreciation each year, just not as much as you would if you didn't take the bonus depreciation. So why would somebody do this? Well, what we were just talking about, if you have a property you sell and there's a lot of tax liability, this is how you bury that tax liability. So that $300,000 in bonus depreciation, if you sold a house for $1 million, let's say you had another house. Actually, let's say you had another house that you bought for $300,000 10 years ago, and you sold it for $600,000. So you had $300,000 gain on it that you would be taxed on normally. That $300,000 is now going to offset that gain, and there's no taxes. That's how this becomes really powerful, is you make that tax just disappear. So, and when you sell that first house, you get that $300,000. You don't have to take that full $300,000. In a 1031 exchange, yes, you do have to roll all that money over. But with this strategy, you only need to put 20% down. So if you're doing 20% on $1 million, that's only $200,000. So you put $200,000 into this $1 million property, and you get a $300,000 tax write-off. And you still have $100,000 that you're holding of tax-free money, and you have a property that's worth almost double of the previous one that you had. So now when appreciation happens, let's say appreciation goes up 10%, instead of 10% on a $600,000 property, you're now getting 10% on a $1 million property. Or in our case, where we're doing it times 3, well, let's say we're buying 3 smaller houses instead of a big one, you're multiplying it by 3, not just by 1. So that's where this becomes really powerful, and you can see the velocity of equity starts to snowball and just increases your overall equity over time as you do this strategy. So they say, like, and I've heard this before, like you can sell, create a tax problem, which this would do, but then you can erase it with depreciation. So this is just a tool that is now available to be able to use for that strategy.
Would you say this is in place of a 1031?
So 1031, we might do a combination of both, because these are rental properties. So we have the ability to be able to do both. So what I'm looking at doing and talking to the CPA about is whatever portion that we're using as our down payment, can we use that portion as a 1031 And then we get the bonus depreciation to kind of help eat up more of this tax liability to get there without having to deploy as much capital back into real estate. But it's just different. So the 1031, you don't bury the tax liability doesn't disappear. You just defer it. And so even though let's take that first scenario, you have $300,000 of tax liability, and if you're doing a 1031, you would have to take that full $300,000 and put that into the next property. Whether you buy a $300,000 property or just a $300,000 down payment, doesn't matter. As long as you put all that money into the next property, you don't pay taxes on that, but the tax liability doesn't go away. It just defers it to the next property. So you're keeping it locked. You're kind of the same situation. You're keeping it locked up in the property. And then when you go to sell that second property, then you have the same situation. You're going to have even more tax liability, and you need to either 1031 it or pay the taxes on it. So with bonus depreciation, you can actually kill it and stop the tax liability right there and just get rid of it. You bury it, and then you pull that money out, and you're not paying taxes on it now.
So really with a 1031, if you were to keep doing that over and over again, you'd be snowballing your taxes, right?
You would be snowballing the tax liability until you die, which we've talked about. You can keep doing that strategy until you die, and then those tax liability dies with you, and then your kids can sell that property and not have to pay those taxes.
This is why you said, or like you said, planning. You
Planning,
cannot just do this
It takes
last
planning.
minute. This isn't something you're going to start talking about December 1st.
There are two
trying to
different
figure it out.
strategies that have a similar outcome because you're just trying not to pay taxes. One of them is deferring it until you die. The other one is burying it. So it allows you to be able to just kill that tax liability in its tracks. And the thing is, you do not have to roll that money over like the 1031. If you were able to get creative deals and buy with zero, let's say you bought something with zero down, you wouldn't even have to use that money towards real estate at all. You could keep all that. As long as you buy a property, you're able to take the depreciation on that. So you don't necessarily have to roll it over as a down payment. That's just usually what it takes to buy a home.
So what would you say for someone, because like you said, you have to be a real estate professional, not a licensed realtor, but a real estate professional. What would you say to someone who is not? What are their options then?
Yeah. So, I mean, if you're not a real estate professional, it gets a little trickier because you can't take that. If you or your spouse are not, you're not able to use bonus depreciation to offset active income. So you can still use bonus depreciation to offset passive income, but it stays within that passive income because the IRS treats passive income and active income differently. So the income that you're making from your investments, like from your, let's say, all your rental properties, that's considered passive income. You can still use the bonus depreciation against that. So if you had a bunch of passive income, you could still use this strategy and not even have to worry about a real estate professional. But for us, since we're selling the property, when you sell a property, even though that's a real estate transaction, those gains are not treated as passive. Those are capital gains, which are basically lumped in with active income. So in order to offset those gains, the capital gains, you have to be, again, either a real estate professional to offset that with bonus depreciation, or you can 1031 it, or you just pay the taxes, which we don't really want to do.
Yeah.
So I mean, it's the fact that we are heavily involved in real estate and spend a lot of time in it and are able to qualify for that makes this a viable strategy for us.
When would you say, when you were kind of like looking at this, when would you say does not make sense to sell a property?
Yeah, I think it doesn't make sense when you don't have a lot of equity. When you're building, you're in build mode, like we've been the last 5 years, and you're just trying to build up that equity. It doesn't, because your return on your equity might be really, if you buy a property, let's just say you buy a property zero down, $1 million property with zero down. You have zero equity, but you're getting an income on that. Your return on your investment is actually really extremely high because you have no money in there. So your return on investment is infinite. The more money you make on the property, you're dividing by zero because you have nothing into it. But your return on your equity is also going to be really high because you have zero equity at that point. Now, as time goes by, you hold that property 5, 10, 15 years. Let's say it doubles in value over 10, 15 years. Now that property's worth $2 million. Now you have $1 million of equity in there. And so now your return on equity goes way down. Your return on your investment's still good, but the return on equity is now lower. And now you got this opportunity cost that you're missing out on by not redeploying that equity. So I would say somebody that's just getting into properties and hasn't held them very long or doesn't have a lot of equity. Now, with what we do, we push appreciation. So we get there a little quicker because we do a lot of renovations and we push that appreciation quickly. But when you first get into the properties, there's not a lot of equity. So you're kind of starting at zero. And at that point, like it doesn't make sense to sell because there's not really much gain. But I think definitely like the farther along you go and the closer you get to doubling the value is when you really got to start looking at your return on your equity.
Yeah, makes sense. So what is something that our listeners can do right now to figure out if their property makes sense to sell or not?
Yeah, I think there's a few things you should do. One is figure out what your return on your equity is. Look at your equity on each property and figure out what the return is on the equity, not the investment, not the value of the home, on your equity. So again, $1 million property, let's say if you bought it at 600, let's say you owe $600,000 on it. It's worth $1 million. You got $400,000 of equity. What is your return on that $400,000 and what does that look like? And then you just got to figure out what could this do elsewhere? If I take this and I redeploy this and buy 2 or 3 properties, what do the numbers look like? You do have to consider rates are higher right now. So you might have a rate that's 2.5%. Maybe it makes more sense to keep it there and just try to keep getting second, thirds and try to tap into the equity other ways, or a home equity agreement, just ways to tap into that without losing that first position, because that could really help your cash flow and it might not make sense to give that up. But especially if you've got a property that's like, 5, 6, 7%, if you're not really losing out on the interest rate right now, it could make a lot of sense to do that. The other thing too is there are portable mortgages. We talked about portable mortgages. Some mortgages are actually portable. They're not as common, but there are some portable mortgages. So if you're buying your next property as a primary residence, you might be able to take that 2.87% that you have and apply that towards the next property. And that's a little more complicated. You got to really look into it and find out if your mortgage qualifies for that. But that's one way of doing it. Another thing that's actually not talked about very much is assumable mortgages. So when you're buying a property, if it's an FHA or a VA loan or an FDA, those are not as common, at least not in our area. But those are assumable mortgages. An FHA, VA loan, anybody can assume that. You don't have to be a VA to assume a VA loan. There is some caveats on the VA side, but the FHA is just anybody can assume it. You still have to qualify for it. But if let's say somebody bought a couple years ago and they don't have a lot of equity built up for whatever reason, but they have one of these loans, you could potentially come in and take over that loan. And it's not subject to, you have to still qualify with the bank for the loan, but you take those same terms that are already in place. So if it's 2 years gone and there's 28 years left, you still only have 28 years left on that. So you literally just pick up the loan where they're selling, but you would get that same interest rate, same terms, everything would be the same. You may have to come up with some additional money down if they do have equity because you still got to buy the house out. You're only going to get that loan for that amount because the terms don't change. But that is a really strategic tool that I don't think is utilized.
I was going to say, why do you feel like people don't use that as often?
I don't think people know about it. I think it's something that's just not talked about very much. And so I don't think that a lot of buyers are aware of that. I think we had some friends that were looking at doing that a couple of years ago.
Yeah.
It was an assumable mortgage.
But the mortgage on the house that they're buying has to be assumable, right?
Correct.
So
yes.
So the property, say for instance, one that we're selling has to be assumable. So the buyer coming in, that's the only way they could take that over.
Right.
So if you don't have an assumable in place, you can't.
Right. So your loan has to be an FHA or a VA. You have to have a loan that's assumable to be able to pass on. But that's also a selling point too. You can say, I have an assumable mortgage and the rate is 2.87%.
Wow, why don't people talk about that?
I just don't. I don't know why. I think it's really underutilized.
That's interesting.
But I would say the other part of this, kind of looking at your situation, is also what is your tax plan? You got to figure out what is your tax strategy. You got to do. Timing is important. You don't want to sell that home and create a $400,000 tax liability that you can't mitigate. So,
and like we said, we had so many people saying why are you selling last year when this would not have made sense?
Yeah, I mean, the last few years, it's like we didn't have this opportunity. We would have had to do a 1031 and we would have had to roll all the money over and it wouldn't have really helped us personally out because we couldn't redeploy that. We had to put it all back into the next property. So yeah, we might have actually been able to do it. And it might have made sense and we probably should have looked at it sooner. But now with the bonus depreciation, now we can redeploy, buy more properties, and have tax-free cash that we don't even have to reinvest. It's just cash. So I think that's where the advantage comes in, is you're getting tax-free dollars and pulling that out. That's the huge advantage to the bonus depreciation strategy.
Yep, absolutely.
Yeah. I think what we've been talking about with this strategy, I think most people listening probably understand the strategy. They probably agree with it. They can see the benefits of it, but most people aren't going to do anything about it. And we're probably guilty of that the last few years, just building up equity and just kind of getting caught up in that equity trap. But the market doesn't reward knowledge. If you have the knowledge and you know how to do it, it doesn't reward you for that. It rewards action. You've got to take action. So just doing an evaluation on your portfolio and seeing where can you redeploy, where can you be better off. If you've got properties that are if your return on your equity is like less than 10%, maybe that's time to make some decisions. Where can I redeploy this? And if I can get 10% on 2 properties and be better off, or even above that, because remember, your return on your equity is going to start out higher when you have smaller equity in the home, and as long as you're cash flowing it, that return is going to start out. It's going to start out higher because your equity is lower, and over time it gets lower and lower. So you just need to look at it. If you've got stuff that return on your equity is under 10%, like definitely dig in and see if it makes sense for sure.
Yeah, I like it.
All right, so we will do an update on this as we list these property. We're going to be coming to market in the next few months, so we're going to know pretty quickly what our whole game plan is. But just planning ahead of time, we're thinking about the taxes before we're even thinking about the selling. So to make sure that we can mitigate that, because it would generate a massive tax bill, which is why we haven't done this. That's been a big holdup, I would say. But that's this is just this opportunity that we have now that we didn't have before. So
yeah, I agree. And if you're looking for a house in Costa Mesa, reach out to us.
Yeah, we got a few of them. All right, guys, that's it for today. Our school community. We are up and running with the school community. We've been doing calls weekly, and we take a podcast episode and then dive in on the call and take questions. Those have been really fun for people to kind of get a little more, related to their situation and find out a little bit more.
I was going to say, that's a really good way to see how it's actually applicable to you in your life and kind of real life scenarios. So
yeah, it's nice too, because as we talk about on this podcast, you might be like, oh, that's a good idea. I wonder if I can do that. But it gives people a chance to stop me, ask questions like, so this or that, can I do that? And we can kind of dive into their situation a little more. So those have been really fun. But school community is up and running, so you can join that. We'll have the link in the show notes. And then, so it's just been fun.
And then, like always, if you have anyone that might be a good guest on the show, we're always open to suggestions. And continue to keep rating us and subscribing and liking and all the...
Yeah. And with people on the show, we do have some people lined up, but we get a lot more requests to come on the show than we actually take, because we want people that are going to be relatable to people that are listening.
Right.
So we're trying to keep it kind of in the same niche, and kind of people that are doing investing, not always real estate, but kind of, definitely more real estate heavy. But we're definitely trying to keep it staying in the lane. So we get a lot of people that were like,
doesn't make sense.
Yeah, that's like,
yeah.
Like, I know you want to get on a podcast, but that's not relevant to what we talk about. So we definitely do want to keep things relevant.
Absolutely.
So, all right, guys, get out there and make it happen.
Thanks for listening. This has been a production of Rebuilding the Dream Studios.